California's 2025 housing crash is accelerating, faster, deeper, and more brutal than anyone predicted. Median home prices statewide are still hovering above $750,000, but buyers have disappeared and inventory has exploded by over 60% in some regions. Mortgage payments now exceed $6,500 a month in many areas, while incomes remain stagnant, creating a crushing affordability gap. Foreclosures are spiking, up 30% to 45% year over year, and homes that once sold in days are sitting for 60-plus days with steep price cuts. Welcome to California's ghost towns in the making, where booming suburbs are quietly turning into America's next big real estate regret. Number 10. Mission Viejo. Mission Viejo, once a symbol of stable suburban affluence in Orange County, is now flashing red warning signs in the 2025 housing landscape. With a median home price of around $1.24 million as of mid-2025, the city has seen home values surge nearly 83% since 2020. But that growth may have overextended itself. Local listings have ballooned by 38% year over year, while buyer activity has dropped over 27%, according to regional MLS data. Homes that once sold in under 2 weeks now linger for 45-plus days on average, signaling a major cooling of demand. The affordability crisis is becoming Mission Viejo's Achilles heel. The median household income sits at roughly $117,000, while a standard 20% down mortgage at 6.7% interest requires a monthly payment of around $7,100, more than 70% of gross income for many families. That debt-to-income imbalance is pricing out younger buyers and pushing even long-time residents toward cheaper inland markets like Menifee or Murrieta. Inventory levels have surged, with nearly 1 in 5 listings seeing price cuts. Foreclosures and pre-foreclosure filings have jumped 19% since Q4 of 2024, particularly troubling for a city that had relatively low delinquencies during past downturns. The once bustling retail centers like the Shops at Mission Viejo are now seeing higher vacancy rates, and restaurant closures are up 12% year over year, according to the Orange County Business Journal. What's especially alarming is the broader demographic trend. Mission Viejo's population has declined 2.1% since 2022, as retirees and younger families alike opt for more affordable regions. Public school enrollments are also down by over 5%, hinting at a shrinking family base. With fewer incoming residents, stagnant wages, and elevated housing costs, Mission Viejo's pristine streets now echo with a quieter, uneasy stillness. If current trends persist, this once thriving suburb could be one of Orange County's first major post-pandemic ghost towns. Number 9. Costa Mesa. Costa Mesa, known for its vibrant art scene and central location in Orange County, is now contending with the painful side effects of an overheated housing market. The median home price in Costa Mesa reached $1.38 million in early 2025, nearly 95% higher than pre-pandemic levels in 2019. While this city has long attracted professionals, artists, and entrepreneurs, it's now witnessing a rapid downturn. Housing inventory has jumped by 41% year over year, and homes are sitting on the market for 52 days on average, up from just 19 days a year ago. The affordability crisis is particularly intense here. With a median household income of around $103,000, monthly mortgage payments for a typical home now exceed $7,800, over 90% of take-home income for many buyers. This has priced out younger creatives and tech workers who once flocked to Costa Mesa's walkable neighborhoods. Rental prices, once a buffer, have also climbed to an average of $3,450 per month, leading to a net population outflow of 2.8% over the past 2 years. Small businesses are feeling the pressure too. Vacancy rates at retail centers have doubled since 2023, and commercial lease rates are down 17%. Cultural landmarks like the LAB and the Camp still draw some foot traffic, but several boutique shops and independent restaurants have shuttered, leaving behind rows of "for lease" signs. Office space availability has surged 26%, suggesting that remote work trends and business exits are taking their toll. Costa Mesa's once bustling charm has slowed to a crawl, with high property taxes, increasing insurance premiums, and mortgage rate volatility hovering around 6.6%. Even longtime homeowners are considering relocating. If trends continue, Costa Mesa could transition from a creative epicenter to a cautionary tale of what happens when real estate growth outpaces economic reality. The energy is dimming, and many fear the soul of the city could be next. Number 8. Aliso Viejo. Aliso Viejo, a master-planned community tucked in the rolling hills of South Orange County, once represented the dream of modern suburban living. But in 2025, the reality is shifting fast. Home prices here hover around $1.02 million, nearly 88% above the historical average for similar-sized Southern California suburbs. That growth, fueled by speculative demand and limited inventory during the pandemic, is now backfiring. Over the past 12 months, listings have increased by 45%, and homes now sit on the market for an average of 56 days, up from just 14 days in early 2023. The typical household income in Aliso Viejo is about $112,000, yet monthly mortgage payments now top $6,400, excluding taxes and insurance. This means many potential buyers are priced out, especially first-time buyers who are facing record-high interest rates. The city's population declined by 2.3% over the past 18 months, and rental occupancy is also shrinking, with landlords offering concessions like one-month free deals just to fill units. Aliso Viejo's once thriving corporate office parks are experiencing a slow bleed. Commercial vacancy rates have climbed by 21%, and some buildings along Aliso Viejo Parkway are now underutilized or vacant. This affects the city's tax base and puts additional stress on local services. Nearby shopping centers are seeing a similar decline. Traffic is down, and anchor stores are reevaluating leases. What's particularly troubling is the foreclosure activity. In the first quarter of 2025 alone, Aliso Viejo saw a 31% increase in foreclosure filings compared to the previous year. Homeowners who bought at peak prices in 2021 to 2022 are now underwater, and many are walking away from mortgages that no longer make financial sense. Aliso Viejo's master-planned streets remain clean and quiet, but that calm now feels eerie. With declining demand, rising debt burdens, and increasing vacancies, the city's polished facade is starting to crack. Number 7. San Clemente. San Clemente has long been a postcard-perfect coastal enclave in southern Orange County, with Spanish-style architecture, bluff-top views, and world-class surfing. But in 2025, the city's luxury real estate market is showing serious signs of decline. The median home price currently sits at a staggering $1.72 million, placing it nearly 106% above its long-term historical trend. While the city once catered to wealthy retirees and vacation home buyers, today's economic climate is making that luxury unsustainable. Mortgage rates hovering around 6.7% have made financing these homes brutal. A standard 30-year fixed loan on a typical San Clemente house now demands monthly payments of $9,800, pricing out nearly all median income earners in the area. The average household income is about $118,000, which means only the top 10% can realistically afford to buy here. Listings are up 49% year over year, and price cuts are happening on nearly 40% of all active homes. Rental demand is also softening. The average rent for a two-bedroom is now $3,750, and occupancy rates have slipped by 5.2%, pushing landlords to offer concessions not seen since the Great Recession. Meanwhile, population growth has stalled, with a 1.9% net loss since 2023. Remote workers who once flooded the market are now retreating to more affordable inland options. Tourism, once a buffer, is no longer enough. Boutique hotels are struggling to maintain occupancy amid soaring insurance costs, and some beachfront businesses have shut down due to reduced foot traffic. Downtown shops and cafes are seeing a 16% drop in sales from last year. San Clemente still boasts incredible natural beauty, but beauty alone can't pay the mortgage. The market has shifted, And unless prices correct substantially, San Clemente risks becoming a quiet coastal shell of its former self. An oceanfront ghost town waiting for a reset. Number 6. Tustin. Tustin, nestled between Irvine and Santa Ana, has traditionally been a more affordable gateway to Orange County living. But in 2025, even Tustin is spiraling toward a housing correction that threatens its stability. The median home price now sits around $1.21 million, a jump of more than 87% since 2019. With mortgage rates hovering at 6.7%, monthly mortgage payments for a median-priced home exceed $7,000, while the median household income is only about $105,000. That debt-to-income mismatch is pushing buyers to the sidelines and sending inventory through the roof. Listings have increased by 42% year over year, and days on market now average 54, up from just 18 days during the 2021 boom. Nearly 35% of listings are experiencing price reductions, and several sellers have pulled homes entirely rather than accept lower offers. Rental properties are not immune either. Rents have stabilized around $3,300 per month, but vacancy rates have crept up to 7.1% compared to 4.5% just a year ago. Adding to the downward pressure, Tustin's small business sector is seeing erosion. Commercial vacancies are up 22%, and local restaurants and retailers are struggling with both lower foot traffic and rising overhead. The once reliable influx of remote workers and young professionals has slowed dramatically, with a 2.4% drop in population since 2022. Foreclosure filings have surged by 28%, particularly among homeowners who bought with adjustable-rate mortgages during the low-interest craze of 2021. Those who stretched themselves thin to buy into Tustin's rising market are now facing ballooning payments they can't meet. Tustin still offers charm, centrality, and historic neighborhoods, but those assets are being drowned out by financial stress, unaffordable housing, and growing economic uncertainty. Without a sharp correction or revitalization effort, Tustin risks drifting toward ghost town territory. High prices, low turnover, and an increasing number of vacant homes and businesses. Number 5. Modesto. Modesto, once seen as a haven for Bay Area transplants fleeing high costs, is now facing its own reckoning. As of mid-2025, the median home price in Modesto is approximately $410,000, down from its 2022 peak of nearly $460,000. That 11% drop may seem modest, but it's paired with a massive 52% surge in active listings, creating a clear oversupply issue. Buyers have dried up as mortgage rates near 6.8%, pushing monthly mortgage payments over $2,800, a steep climb for an area where the median household income is just $66,000. During the pandemic boom, Modesto became a hotspot for remote workers and investors. But now that wave has reversed. Home values are down, rent prices have stagnated at around $1,800 per month, and population growth has stalled. In fact, the city recorded a 1.7% decline in residency over the past year, a stark reversal from the influx seen in 2020 to 2021. Even more troubling is the rise in foreclosures, up 34% year over year. Many of these defaults are tied to buyers who entered the market with low down payments and now owe more than the property is worth. The number of underwater mortgages has climbed to 13%, and delinquency rates are increasing, particularly in neighborhoods east of McHenry Avenue and south of downtown. Commercially, the city's malls and retail strips are showing visible stress. Vacancy rates have climbed above 18%, and job losses in the service and warehousing sectors have contributed to rising unemployment, which now hovers at 6.4%, well above the national average. Modesto's promise of affordability has become a trap for many, with falling prices, stagnant wages, and shrinking demand painting a gloomy picture. Once seen as a safe escape from California's high costs, Modesto is now one of its most vulnerable housing markets heading into the second half of 2025. Number 4. Riverside. Riverside, long considered the heart of the Inland Empire, is facing a troubling transformation as the 2025 housing downturn unfolds. Once a refuge for families priced out of coastal cities, Riverside's real estate market has reached unsustainable levels. The current median home price is $565,000, up more than 68% from its 2018 level. But signs of overvaluation are now flashing bright red. With mortgage rates still above 6.6%, monthly payments on a median home surpass $3,800, while the median household income in Riverside sits around $74,000. That gap is forcing many would-be buyers to delay or relocate entirely. Inventory has ballooned, with active listings increasing by 47% year over year. The average time a home stays on the market is now 59 days, up from just 21 days 2 years ago. Roughly 33% of homes have experienced price cuts, and seller incentives like rate buydowns and closing cost credits are becoming common. Foreclosure activity has surged 39%, especially among homeowners who purchased with FHA loans and minimal equity during the peak buying frenzy of 2021 to 2022. Rental markets are also strained. Average rent is around $2,650 per month, but vacancies are ticking upward and landlords are struggling to attract quality tenants. Simultaneously, job growth has slowed. The logistics and warehousing sector, once Riverside's economic engine, has seen layoffs and contractions due to reduced shipping demand. Unemployment has edged up to 5.9%, eroding economic stability in the region. Commercial real estate is feeling the pinch as well. Retail vacancies are up 14%, and several strip malls show signs of long-term neglect. With declining home values, rising defaults, and slowed economic growth, Riverside's trajectory is shifting from regional success story to cautionary tale. If current trends continue, Riverside could soon resemble a post-boom ghost town, where inflated prices and over-reliance on volatile industries leave neighborhoods half-occupied and equity disappearing by the month. Number 3. Bakersfield. Bakersfield, often dubbed the energy capital of California, experienced a pandemic-fueled housing surge that brought massive migration and inflated home values. But in 2025, the story has flipped. The current median home price sits around $390,000, down from a peak of $440,000 in late 2022, an 11% decline. While still considered affordable by California standards, the city is now seeing housing demand dry up faster than expected. Listings have soared 58% year over year, and homes now sit on the market for an average of 61 days, double what it was in early 2023. The median household income in Bakersfield is about $63,000, yet the average monthly mortgage for a new buyer now exceeds $2,600. With mortgage rates near 6.9%, affordability has plummeted. Many buyers who rushed in during the remote work boom are now looking to exit, often at a loss. As a result, foreclosure activity has increased 41%, and underwater mortgages are creeping back, particularly in newer subdivisions on the city's west side. Bakersfield's economy, heavily reliant on oil, agriculture, and logistics, has also softened. Recent layoffs in the warehousing sector, combined with lower oil demand, have pushed unemployment to 7.1%, significantly above the national average. This has rippled into the housing market, with more sellers than buyers and developers delaying new projects. Renters aren't safe either. Average rents hover around $1,650 per month, but vacancy rates are rising and landlords are beginning to offer discounts. Retail centers are also feeling the downturn. Several big box closures have left entire shopping centers hollow, and commercial vacancies are up 19% year over year. What once felt like a rising star in the Central Valley is now on a shaky foundation. With falling prices, job losses, and increasing vacancies, Bakersfield is inching closer to economic and residential stagnation, turning once vibrant neighborhoods into eerily quiet blocks. Number 2. Stockton. Stockton has long been a poster child for housing market volatility. After declaring bankruptcy in 2012 and seeing one of the nation's worst foreclosure crises, the city had made a strong comeback. But in 2025, Stockton's housing market is once again teetering on the edge. The median home price is now $420,000, down from $475,000 in 2022, a 12% decline. While still relatively affordable, this drop has been accelerated by surging listings, which are up 55% year over year, and demand that's dropped like a rock. With interest rates hovering around 6.8%, the monthly mortgage on a median home now exceeds $2,850. Painful in a city where the average household income is $62,000. That math simply doesn't work for most families, pushing more buyers out of the market. Delinquencies are rising sharply, and Stockton has seen a 38% increase in foreclosure filings since Q2 2024. Many of these are tied to buyers who entered the market during its frenzied pandemic peak. Rentals haven't escaped the downturn either. Average rents are stuck around $1,750 per month, but with rising vacancy rates, landlords are slashing prices or offering perks to retain tenants. The city's population, which grew rapidly in 2020 to 2021, has since fallen 2.9% as remote workers return to metro hubs or leave the state entirely. Economic pressure is also mounting. Stockton's unemployment rate has ticked up to 6.8%, driven by layoffs in retail, logistics, and public services. Meanwhile, commercial development has slowed, and small businesses are shutting their doors. Some neighborhoods that once buzzed with new construction now look half-abandoned, with unoccupied homes and for sale signs lining the streets. Stockton is again trapped in a vicious cycle: falling prices, rising foreclosures, and dwindling confidence. Despite past recovery efforts, the city's 2025 housing market feels eerily reminiscent of its darkest days. Except this time, the warning signs are flashing even earlier. Number 1. Irvine. Irvine has long been seen as the pinnacle of suburban success: master-planned communities, high-ranking safety, and pristine landscaping. But in 2025, it's becoming the epicenter of California's housing crash. The median home price in Irvine is a jaw-dropping $1.62 million, and despite its prestige, that number is now working against the city. With 30-year mortgage rates near 6.9%, the monthly cost of ownership exceeds $10,000, pricing out even six-figure earners. Meanwhile, the median household income, though higher than most cities at $118,000, still doesn't come close to supporting today's mortgage burdens. Inventory has ballooned. Active listings are up 63% from a year ago, and days on market now average 66 days, compared to just 12 during the 2021 peak. Nearly 38% of homes have seen price cuts, and buyer demand has evaporated. Foreign investment, once a driver of Irvine's luxury boom, has slowed significantly due to global economic uncertainty and stricter lending policies. Rental markets offer no relief. Average two-bedroom apartments now rent for $3,950 per month, yet vacancies are increasing as renters migrate inland or out of state. The population growth that once powered Irvine has flattened. Net migration has been negative since mid-2023, and school enrollments are down 4.1%. Commercial spaces aren't faring much better. Office vacancies have risen 22%, and several mixed-use developments are stalling. High HOA fees, rising insurance premiums, and hefty property taxes only add to homeowner costs, fueling a broader exodus. Foreclosure activity, while still modest, has ticked up 31%, especially in newer high-end developments where buyers stretch themselves financially. Without major price corrections or government intervention, Irvine is poised to become a cautionary tale, a gleaming, expensive suburb with more homes than buyers and an economy sagging under its own weight.